Thank you for joining me for a look at the stochastics indicator. In particular, I want to answer the question, does the stochastics indicator really work? And by work, I mean, is it profitable and worth the effort? So I do address questions like this on my YouTube channel. If you find the question to be interesting and the answer to be useful, please consider subscribing to my YouTube channel by clicking below. First of all, the stochastic is one of the most popular momentum indicators. There's the formula for it. It's designed to see where the close is relative to the recent price action. And strictly speaking, it's the close relative to the range being the difference between the high and the low over the time frame. Here's what it looks like on a chart. And the first calculation is the faster line. The second calculation, the blue line here, is the moving average of that. So when the fast line is above the slow, it's giving a buy signal, and the opposite condition is a sell signal. It's designed to work based on the idea that when prices are moving up, traders are going to push that price up as high as they can and keep it there through the day. So you're going to close near the high. In a downtrend, the close tends to be near the low of the range. That's the whole basis of the stochastic. Now, the number of the stochastic does have some importance. The moving average can be added just to make the trade signals clearer. So the moving average is merely an easier way to generate trade signals. That is how it's traded. Some traders will sell when it gets too high. They will assume prices have risen too far too fast. When stochastic values are very low, it generally means prices have fallen very quickly, and many traders believe they'll reverse in the short run. Traders also will use the two lines, trading crossovers, and others will simply use the stochastic as a filter, telling them when the risk in the market is low for their particular trade. Here's what the signals look like on a chart, and as you can see, some of them work well, some of them don't. Fact is, here's two buy signals, one relatively profitable, one not so profitable, and in general, the signals have a very mixed record visually. Well, we can test that. And what we find in testing various entry conditions, comparing it to a random entry, daily data, so calculating the stochastic using just a regular daily chart, you're not going to beat a random entry. So the indicator itself does not help you with daily data. Weekly chart holds a little bit more promise. Our eyes probably immediately drawn towards the center where we do seem to have some nice signals. Our eyes tend to ignore the signals that don't work as nicely. Testing again shows that the stochastic will not beat a random entry. Now, if it won't beat a random entry, in my mind, it simply doesn't work because I'm doing a lot of extra effort to get subpar returns, and that just defeats the purpose of calculating the indicator. And I know it only takes a second to add it to a chart, but if you're not beating the market, there's no reason to add it to a chart. Can it be used? It can be. It works well combined with MACD on a weekly chart or even a monthly chart. Just set the level to 50. If both lines are above 50, it's bullish. When both are below 50, it's bearish. When only one of the lines crosses 50, wait for the second one before you have your signal. Combine this with MACD. Only take the MACD signals when it's confirmed by stochastics, so only sell using MACD when stochastics falls below 50. This combination actually does reduce risk and will keep you out of significant bear markets. In all my research, this is the best use of the stochastic that I've found. It simply won't work to get you market-beating results on its own. I hope you found that to be useful. And if you did find this video useful, please consider subscribing to my YouTube channel below. Thank you.